Markets are looking a little bit toppy here. Look at this price action right now. Not as strong as what we saw on this up move. So the question is, what's going to happen from here? Are the markets finally going to take a break? Best case scenario is that they move sideways and consolidate for a bit. Worst case being that they crash and make a lower low from here, which I know most of us don't even think is possible with Powell holding everything up with his money printing. But you know, we got to look at all the scenarios. And that's what we're going to do in our market review in this video. And as always, if you're looking for a strategy that's able to manage these markets, then definitely check out our free training. There's a link in this video and down below in the description and comments. In our training, we go over the strategy that most of our members, including myself, use to play these markets. Check it out, it's free. And as always, we're gonna go to MacroOps, our macro research firm, for the latest news on what's happening. So here's an interesting chart shared on Twitter about what happened with this latest market crash. Very different from the other ones. This is for macro charts. He said, when the history books are written about 2020, save a page for how stocks plunged at the fastest pace ever, and nearly all news stories contain the word buy at the exact bottom. It may have been the only time in history this has ever happened. Time will tell, YOLO. And you can see right here, you can track the number of news stories that had the word buy, and it happened to be right at the bottom of the market. And why is that significant? Well, it is because most of the time headlines in the news are not good indicators of where the market is going. In fact, they're more of a contra indicator. So if all the big headlines and all the big publications are saying now is a great time to buy, usually that's at the top of a bubble. It's when everyone's super bullish and the headlines are just late to the party. And when these same publications are saying, hey, there's a lot of pain coming, sell all your stocks now, that's usually a great time to buy. And if this sounds familiar, well, it should, because it's just sentiment analysis. It's another way to do it. Same reason when you're using sentiment in the market, you know that when everyone is bullish, that's when you should look out below. But when everyone is bearish, that's a good time to buy. And these news publications are a great data source when you use it in that way. But in this case, they were saying to buy right at the bottom. They were absolutely right. So that coincides with what the professionals would call the dumb money. So the retail traders, the Robin Hooders. They went and bought at the bottom as well. The only guys sitting on the sidelines are the pros, and they're not happy with this wonky market. They didn't believe in the power of Powell like everybody else. Moving on though, something that we mentioned in a previous video was off-exchange transactions. So this is called the DIX index. So when we mentioned it before, we said that it was hitting an all-time high, meaning a lot of people were buying off the exchanges. Well, last week it broke that record again. So this is really bullish because it shows that large players are purchasing big blocks of stocks in off-exchange transactions. There's a lot of accumulation going on, which is exactly what you want to see if you're expecting the market to move higher. More buying leads to higher prices. And generally, I would think the people buying in these off-exchange markets aren't people actually, but they're more institutions or hedge funds, so they might be stronger hands in the sense that they're buying and they're planning to hold for some time. They're not going to turn around and sell tomorrow. And you can't really flip stocks in a day when you're buying big blocks of them. It takes time to move in and out of positions, which is why you could call these people the strong hands. So there's a report recently published by Bernstein on the CCPV trends. And just to clarify, I call it the Chinese Communist Party virus to differentiate from the actual Chinese people, because there's nothing wrong with the Chinese people, it's their government. I don't know why Trump goes to rallies and calls it Kung Flu. It's an idiotic thing to say, and you don't want people rallying against Chinese people. They're good people under an oppressive regime. So if you need to target the problem, it's the government, the CCP, the Communist Party, not the Chinese virus, not the Kung Flu, just the CCPV, if you're gonna call it something other than COVID. Anyway, in their study, Bernstein is pointing out the troubling trend in the growth cases in the US. So their current projection based off state level trends is that we're gonna hit a new high, even bigger than back in late March and April. And there's two ways to look at it, at the state level trends or the national level. But you can see there is more danger when you look at it from the state level. And obviously this virus matters to markets for a number of reasons. One of them being that if the case count goes too high, we might return to shutdowns. And here's a chart from DB that shows the relationship between the growth of global cases and market volatility. So as we get more cases, the volatility shoots up in the market. And this is actually the growth rate. So as the growth rate increases, as the growth rate decreases, you see we get less volatility. And if we look at this little topping pattern, it's kind of happening as this second wave is coming through. So it's interesting to think about what will happen if we go back into shutdowns. Will the stock market collapse like it did previously? Will the stock market collapse again like it did previously the last time we had shutdowns and an outbreak? Or are we going to have the Federal Reserve step in again? So we get a shutdown and they start printing, and then there's more transfers to people. They get more money in their pocket and they start pushing the market up again higher, just like we previously saw. Now, if you think about it, if the Fed Fed did this again and the same thing played out, it should be less effective, because maybe people will think, hey, this might be a longer term thing. Hey, my job isn't going to come back. Instead of piling this money into the market, maybe I need to hold on to it. You would think that could possibly happen. But at the same time, if the Fed really steps on the pedal and does even more, people might just continue to throw it in the market with even more firepower behind them. So we'd really have the fakest bull market ever. Just pure stimulation by the Fed. Really, I could see it going either way. Now, this whole thing has acted as an accelerant on many existing trends, especially the rise of e-commerce. So this chart from RBC shows the rebound of brick and mortar since, the lockdowns have stopped. So this is like in-store, actual stores, not online. But even with this rebound, this trend in online sales have not stopped. So there's a lot of predictions that this whole lockdown would force a permanent change in consumer behavior, which wasn't really a controversial opinion because we knew the trends were going there anyway, but now we could see the data is backing it up. So we might be in a new normal, which in some areas does suck because it was always nice going out, but in other areas it's okay. Like a lot of these restaurants are doing amazing carry-out deals and their service is way better, and the question was, are they going to continue to do this when they open back up? Because even if you're open, there's a lot of people that don't feel comfortable coming in. The more prudent people like myself, who will lock myself away until this thing is over. And so far it looks like they have continued. And that's just a micro example. There's been changes in every type of business. And of course, if you're a business owner, then it's been a complete mess these last few months. But as the adjustment happens, there's going to be some pluses and some minuses. Here's an interesting chart about the percentage of US consumers who think things will be better in 6 months versus those who think they'll be worse. And you can see that both are hitting new 10-year highs. So there's a ton of people who think it's going to be a lot better and a ton of people who think that it's going to be a lot worse. Sometimes you get confusing data like this. And if you look at an aggregate of consumer confidence, which is this red line, you can see how it's absolutely plummeted. But at the same time, this white line, which is the market, it keeps going up. And there are really not too many other times in history when these two lines were so disconnected. Normally they move in the same direction, which is just more data to show that the economy is not the stock market. They are two separate things, at least in the short term. So it's a dangerous thing to try to look at the economy and how bad it is and try to relate that to the stock market in the next few months, even in the next year, because the time frames don't work out. And I'll talk more about that in a second. Right now, nearly 20% of US firms are considered zombie companies. And you can see this trend has just been accelerating since every crisis, because every crisis that we have, everything gets papered over. This happens. So those companies that should be failing, they don't fail. And a zombie firm is a company whose debt servicing costs are higher than their profits, which means it's like a company that's just drowning in debt. And this is not good for a capitalistic system, because at that point, is it even capitalism? You're getting bailouts left and right, and this is what you get. This is the result. You're not letting the natural capitalistic system take its course and get rid of the companies that aren't able to adjust, that aren't profitable. Instead, we're propping them up. Like Alex says here, we're seeing our markets disintegrate in real time, and it doesn't seem like we have any reasonable people driving the bus who could possibly redirect the course from here. I mean, look at our choices for this next election. You got Trump and Biden. Both aren't looking too good, but in my opinion, politicians in general never look too good. And this whole zombie firms thing is kind of what Druck was talking about. It's the same thing that Buffett was looking at when he got out of the stock market. And we've covered this in previous videos, but this is their concern. And it goes back into that long-term debt cycle. And man, people really hated that last Buffett Druck video that I did. When I called a bunch of billionaire fund managers old and stupid, obviously I'm being sarcastic because these guys know what they're talking about. I fully agree with Druck and Buffett because they are way smarter than me, way more successful, way better at this. They have decades of experience too. The thing I might not agree on that I think a lot of professionals are doing wrong is playing the time frames correctly, which is what I was talking about before. So for example, even though the fundamental view of guys like Druck and Buffett is true, that we're in big trouble with the economy and things are just going in the wrong direction. And again, we have data, we talk about this in every video. We find more and more data that proves that's right, just like these zombie firms. But that might be an intermediate to long-term problem. In the short term, you got to play what's in front of you. So did any of that economic data stop this rally from happening? No, it did not. So at the end of the day, it doesn't really matter, at least in the short term, what's going on with the economy. It just matters if people are buying or selling. You got to play the trend. Now, of course, a guy like Buffett is not going to play the trend because that's not his strategy. He's way more long-term, so him selling out does make sense. If we think the market is going to be in trouble in the long term, which is what he thought. So you can't judge what someone is saying based off a different time frame. So you can't call Buffett an idiot because he pulled out at the bottom. Because for him, on his time frame, it might not be the bottom. For us, in our strategy, in the strategy I talk about in this training, yes, that was the short-term bottom, and that's why we were able to make good money on the way up. So remember, whenever we're going over any of this data, we got to think about what time frame we're trading in. Markets are completely fractal. So a day trader wouldn't even care about this trend because he's looking at trends on the hourly bars, which there are a ton of different ones over a few days. So you always got to morph this data into your own strategy. And even before that, you need to find a strategy and then stick to it, because there's no way to put together what Drux says versus what a day trader says and like come up with something. They're going to be kind of separate. Now, when we're looking at bear markets, Citi's bear market checklist is not giving an imminent warning of one coming. Their checklist is only showing a reading of 30%. You need a reading of above 50% to show some real danger. So you can see right here, right now, 30%, 2007, 59, 2000, 89, and 1990 was 69. So that's one more data point in favor of the market continuing from here. And one of the strongest sectors from a technical standpoint right now is biotech. It's seeing a lot of new highs and it continues to rise. So the space has seen a lot of large outflows recently, which is generally a bullish sign when combined with the fact that the price keeps going up. So if you're looking for individual stocks, definitely look in the biotech space. Now, going back to this chart and trying to figure out what's happening in the short term, we really don't have an idea yet of which way this is going to break because it's still consolidating. And you can see it's consolidating right here on its 200-day moving average. And the 50-day is close to giving it support as well. This should be a strong area to hold, and as you can see, for the past week it has been holding. This big drop that we had on the 11th, it stopped right there. So you really can't make a move in one direction or the other until you see a significant break in one direction or the other. And if we zoom back a little bit, the S&P has really just been trading in this huge expanding wedge. It's like a 28-month trading range. So it's not out of the question to, break up to these new highs, and it's also reasonable to break down to lower lows because it could continue to just keep trading in this range. But again, from a fractal perspective, when we zoom in, we'll have to see what happens here. So you got to kind of be in wait and see mode, which is basically what our strategy does because it plays individual stocks. And currently those individual stocks continue to move higher because the breadth in the market is pretty good. And when you're picking the strongest stocks, you do expect them to move higher. We've taken a lot of profits along the way so that if this thing does break lower, we'll be in a safer space to start cutting our positions. And again, if you want to learn more about what I'm talking about, just check out that free training. Link in this video and down below in the description and comments. If you like this video, make sure you subscribe for more so I could see you in the next one. Stay fallible out there. Bye.